Right, thank you very much, gentlemen, for joining me. If you could just do a 30-second, very quick intro, please. And just as a heads up, this is like very much a founder-led panel. We're here to share our war stories, our battle stories, and hopefully give actually just really interesting, punchy advice, safe space. We can share our challenges and also maybe celebrate some of our successes as well. But we have all been working at the front line for quite a long time. So yeah, and I'm hoping that there'll be some questions at the end as well. And you should see this panel as a resource if you have any difficult questions. We're here to answer them as well. So Mike, let's start with you, please. Introductions.
Great. And hopefully Chatham's house rules, so we can be totally honest and open.
100%. Is there any other way?
Yeah. Thanks so much. Thank you all for staying. I know we have the last panel of the day. I ran around trying to search for coffee, and I only found a coffee machine in the cafeteria that didn't work. So really appreciate everybody staying. My name's Mike. I'm a co-founder and CEO of a business called Boost, which is digitizing supply chains in Africa. We operate across 6 countries. We're a UK registered company, but we're in Nigeria, Ghana, Senegal, Kenya, Egypt, South Africa. We have 2 anchor partnerships with Unilever and MasterCard. So I appreciate you're on the Unilever Nigeria board, so we'll talk later, I'm sure. And before I co-founded and scaled one of the very first fintechs in Africa called Zona from 2009 to 19, which was a mobile money platform across Southern Africa.
Thank you very much. Chika?
Chika, Nwobi. A lot of people call me CN by my initials. I'm founder and CEO of Decagon. Decagon is a vertically integrated tech talent business. So we take exceptional people and help them launch careers as software engineers, including providing them the financing and all the other types of support they need through that journey. And then we help companies to connect with exceptional talents, companies both in Africa, in Europe, and America. But before this, I started this company 6 years ago. Before starting this company, I spent the decade before that doing early stage investing and venture building, help build, through that phase we was part of achieving 4 exits. And the decade before that, I founded and built a company that was called MTech that pioneered the mobile value-added service industry in Nigeria and Africa.
Lovely. Thank you very much.
The last time I was on a panel like this with Uzoma was in front of the bankers committee for the central bank. Okay. And I was trying to get the bank CEOs to give loans to students. And Nigerian banks don't give, that's why fintech exists, because Nigerian banks don't give loan even to proper companies. And it happened from that panel. It was an amazing thing that happened. So I'm expecting some amazing stuff from being on this panel with
no pressure there for any of us. And a seamless segue here to someone who used to be a bank CEO as well.
This is going to be a very interesting panel. So the last time I was sitting with him, I was the CEO of a bank called Diamond Bank. And we merged with Access Bank they bought our retail franchise. And so my name is Uzoma, Dozie, and so when I found myself jobless and realized that we had actually sold the platform that actually used to allow me to do my banking, well, I decided that I better build my own bank so that I can actually do what I want to do. So the whole idea of Sparkle was to build a digital bank for the middle income, affluent and aspiring, and small businesses, because one thing I know about banks is that we are very good at providing services to high net worth individuals, big corporates, and the masses. In between that, very lousy substandard services are on the bank. So I think Sparkle was an opportunity for us to provide, premium banking services for the middle income affluent Nigeria, and which is the journey that we're actually on right now.
Thank you very much. And some of the conversations today have talked about, we need more exits. I'm the only one here who hasn't exited the company, so I'm moderately embarrassed. Chika, how many have you exited?
5.
Okay, now you're just showing off. But I mean, the exits are there, and this panel is going to help us, I guess, talk about some of the challenges, but let's also share some advice as well about the exits as well, because I think that's going to be useful to a lot of people in the room. Speaking on that, then a lot of people talk about there's not enough fundraising, or there's fundraising issues at the moment. Macroeconomic climate is particularly tough as well. How are you managing to continue to operate? Someone mentioned previously, don't die in business as well. So maybe this is a question to all the panel. Firstly, how is the macroeconomic climate sort of affecting you on the front line, and how is that affecting your kind of fundraising activities as well? Mike, let's start with you.
Yes, great question. It is challenging, to say the least. I've been an entrepreneur in Africa for 15 years now. It's always challenging. It's always cyclical. What we did at Boost, I think quite cleverly, this as my second business, was we designed our business model for that. And so we said, we know what the things you can bank on: currency devaluations, macroeconomic hardship, political change. So you have to go in realizing the times now are actually the normal times, right? And I saw when times are good and everybody's like, great, yeah, money's falling from the sky. It's like anybody who's been around the block is just waiting for the down cycle that we're in now. That being said, it's very challenging because you've had big currency shifts and huge devaluations. I have these calls with my team in Nigeria, Egypt, Kenya. They're all talking. Kenya's strengthened now, but for a long time, it's every currency's blowing up. South Africa, I can't even get a call with them because there's load shedding. Right? So there's just constant instability, and then you have. We work with as I mentioned, a manufacturer with Unilever, but their challenges, right? There's inflation. They're struggling with the currency devaluation. There's consumer basket preferences, and then budgets are shrinking, so everybody's under cost pressure. And then you put that on, layer on the VCs, and the environment changed a lot. I remember raising a seed round in 2009 and a Series A in 2012 before they were even counting statistics. We had at my former company, we got a Series A term sheet, and my co-founders and I had to look at Wikipedia and say what does Series A mean? Because it wasn't a thing, right? So now there's these a lot more early stage and pre-seed and angels investors, which is great, and there's some growth capital, but there's these huge gaps in the funding life cycle of a company, and funders and VCs often don't have money in their fundraising, and it's really challenging because it's already, you're working in Africa, when you're fundraising, you already need way more traction. For way less money in way more difficult conditions than anywhere else really in the world. And now that traction bar keeps rising and rising and rising. And I was joking with somebody earlier that seed investors are trying to get a 500K ticket now. We've closed a 5-year agreement with MasterCard and 4 contracts in 4 countries with Unilever, and now I've got investors, seed investors, come back to us when you have a couple more manufacturers and global contracts. I'm do you want me to IPO first before I can get money from you? Right? And so luckily there's more angel investors, so companies are surviving by raising smaller angel rounds, and that's been a saving grace for us in many ways. Institutional investors, very, very tough. And you get a lot of battle scars. So I think the founders that launch new companies are going to do better, because you learn when you do it the first way around that you cash is scarce. Even when it's good, you got to treat it as scarce. And if you burn it quick, you're in big trouble.
Okay, thanks for that. So then, Chika, then you have also worked in VC as well. So maybe help give us your perspective in terms of raising money and building businesses and operations, but also maybe looking at giving us some perspective from the VC perspective as well.
Yeah, for sure. So starting just from how we are operating now. We started this company when things were good, as far as both the demand for what we were building, meaning talent. There was excessive demand for talent, as well as funding and all that. But by default, I like to, partly because of having been on the investing side, and also just my training as a son of an Igbo businessman, I like to not raise a lot of capital and try to get profitable very early. So we didn't have a lot of cash when things started to get very tough. And what we've done is to simplify our business, because our business was very aggressive, very ambitious in terms of trying to solve all the problems in the value chain. So for example, to train people, we find smart people and we guarantee their loans, student loans, which means that we're responsible and involved in we're like a bank, right? Like a lender. But we house them, we're housing them for 6 months, we're feeding them, so we're running a hotel, running a restaurant, as well as running a training business. And then, anyway, so we're stripping down a lot of the things that are more expensive to do, and just therefore we might not be able to serve as many people, but we will, if we can simplify our business, then we can stay alive, not just be alive, but be strong, because there's still a lot of opportunity.
Yeah.
And I think that I think it's very important to understand that if you look at, I've been doing business for doing tech for like 25 years or so, that this is, right now, is like among the best, like not among, it is, in terms of how easy it is to start something or grow something, it is the second easiest in that 25 years. We're taking 2-year windows. So this right after COVID till now, or right before COVID, this whole boom is the easiest. But other than that, this is the second easiest, because there's like I said, a lot more. Everybody knows what seed and pre-seed, and there's accelerator pro. There's a lot of support that wasn't there, but also there's a lot of talents that have been trained, have gone to study for free at the school of startups that other people had raised money for. So there's a lot of capability, and adoption of tech has grown tremendously. So anyway, therefore there's a lot of opportunity. There's still a lot of problems to solve. So operating effectively now is a great time. I think from a VC, if I look at it, if I was a full-time investor, first of all, I'll be suffering. I know that I'm suffering because the big LPs, we still don't have a lot of local LPs in Africa. So the big American and European LPs have, taken flights to safety, right? So they're not investing or it's harder to get tickets, to get checks from them as a VC. And so then I'll be very, very reluctant to add companies to my portfolio, because I want to be able to support the companies I've already invested in. And so that's just something to be mindful of. If you already have investors, even among their portfolio, they're choosing who they're going to help and who they're going to leave, not kill, but who they're going to leave. And so you have to send them your updates, you have to be nice to them, you have to, right? Because that, I think, yeah. And I think related to that, being really humble about getting help now, I think, both as an investor, as an operator, trying to get as much free help as possible through, whether that's through partnerships or through mentorships, or I know a very strong, successful founder who is being very aggressive about recruiting through giving out equity to people who are very senior that can help him, because he's close to the finish line. Yeah. And that's humility, because, anyway, I'll stop there.
The same question to you, Uzoma, but please, let's pick up on what Chika said about profitability. Because a few years ago, it was a dirty word almost. Everyone was just focused on fundraising. And now the tide turned, and VCs just all of a sudden expected these startups to start working towards profitability. But I think maybe there is a crop of startup CEOs who don't really understand how to kind of pave a way to profitability. So same question to you in terms of the macroeconomic environment, but also how do you approach that whilst looking towards aggressive profitability?
Okay. I mean, I think on the macroeconomic problem in Nigeria, it's terrible. It's like, it's really, really bad. I mean, because I'm a bank, so like it's about managing risk. And so I'm faced with FX risk, inflation risk right now, and so everything is going up except, and you can't push these things, so you cannot price in the risk into the services that you're providing to your customers. So you just have to wait it out. So it's only capital now that can save you, and that is like making sure that you understand what your risks are and how you can make that capital burn much slower while we go through this. But it's an economic cycle, and so it's like Chika just said, it's about staying power. Now, I mean, like, so I come from banking, and I think one of the things that you learn about banking is structures, very boring stuff like structures, governance, risk management, and fear, and so and predictability about numbers. And so when I came into the entrepreneurial world, the new like digital world, and there's some things I couldn't understand because I'm working with, so my competition are players in the market that have a different set of metrics, right, that are being rewarded on, that are anti-banking. So it just don't make sense from a banking perspective. Things like, how many, so like, I know that, so like, what are your transaction levels? So like, the more transactions you're doing, or the millions of customers you have, that's great, we're going to give you more money. I mean, I come from a space where, it's how many customers, what are the quality of the customers? What type of transactions are they? Do they make sense? And then I think the biggest ones that I couldn't understand was, that whole concept of knowing your customer and knowing what your customer is doing. So you would see millions of naira of transactions coming from one village in a place where the total GDP of that place was very, very small. And then, so your regulator is not looking at it and not understanding it, because banking is very boring. I mean, there's interest and income, that's all, right? And then there's the affordability of your products and services. There's nothing, there's no magic. Technology just makes it easier, but it doesn't just, it's not an, there's no alchemy in there. And so regulators not doing anything about it. Then we have VCs like Chika who are actually encouraging and fueling the fire, because when you talk to them and you say, I'm going to grow over 5 years and we're going to do we're only doing about 200, 300 customers because we're very scared about, understanding and knowing who our customers are. Then they say but what about your colleagues in the industry? I mean, you can't start bad-mouthing people. And so it just made fundraising challenging. First one, you know exactly where you're going to, you know exactly how you're going to get there. And so you now have to start looking for, and I think fortunately for me, I think because I had been in banking for 30 years, so you have people that have seen what you have done and are willing to back you. So for then it was, okay, that is a limited pool of funding, so you have to raise from there and plus from your own pool, but you have to use it judiciously. And so you're going to focus on building the platform and not marketing, because marketing just burns your capital. You're going to grow. You're going to really grow your customer base organically through your network, through your friends and families, and just hope that and so just stay in there. And so that's exactly what the story is. We're just staying in there and we're growing, and then we're hoping for people to wake up and think, all right, these metrics don't make sense anymore. Let's start asking the questions about, okay, you're in financial services, so tell me about your risk framework. Tell me how you're going to manage your risk in Nigerian risk over the next 2-3 years, and why. Tell me how, okay, instead of saying what's your Pan-African strategy is if you're going to go Pan-African, how are you going to manage regulatory risk across these different countries with different languages and different policies? That's what we want to see. And once we start seeing that, I think, so I'm very confident like Chika that, there's still going to be money for businesses, but there's going to be money for businesses that have actually thought about their business and the risk, that they understand the risk that they're actually facing.
Okay, thank you very much. And then Jermaine, you're from Copia. It would be great to hear some of your insights really about how the kind of macroeconomic climate is kind of helps helps Copia grow, but also some of the challenges that the company's faced as well.
I mean, from Copia's perspective, for those who know about us, it's been a tough, I'd say, 2 years in the funding market. It's been very difficult to raise within our sector just because of the systemic problems that are going on. And I think it's one of those things where you need to build, to have the right business model, you need to build the business model with the right foundations. And I think the e-commerce sector was experienced over the last couple of years in Africa. There's been a lot of focus on top line growth and not enough focus on building the fundamentals. And as a result of that, it's been one of those sectors which has struggled to attract a lot of capital. So in building Copia in the last 2 years since I've been there, is really trying to restructure the entire organization that has the right fundamentals, that has a path to profitability. And I think a lot of African businesses today don't necessarily have that. You need, I came from private equity prior to joining Copia, and from a private equity standpoint, we was only looking at businesses that were profitable, that was number one in their market, had pricing power. We had actually realized many exits. We had done really good investments, and it was one of the best performing funds, just when you look at the returns. So I tried to take all of those sort of principles into into the startup world. And I'd say one of the things I've seen across Copia and also many other startups in the ecosystem is that they don't have the fundamentals in place, and they're not building with the right fundamentals in place. So just to give you a simple example, you want to build a business and you want to sort of hedge against your currency. So you'll find a lot of startups will offer dollarized salaries to a lot of their staff. Meanwhile, their earnings are in local currency. You can't pass on the currency depreciation that you're experiencing onto your top line growth. So one of the important factors is you have to also match all your earnings to also all your outgoings. There's certain areas where you can't do that, for example, software licenses and so on. But to a large extent, that's a fundamental issue you need to resolve as you start building the right foundations. A lot of companies are overhiring, in our markets, which is overhiring for a plan which is 2 or 3 years way ahead of them. You need to hire for the team that you need right now, and you need to keep it lean and try and outsource as much as you can to outside vendors with very focused KPIs. So, going back to your question on the challenges we're facing in this market, I think, the reality is now setting in for everyone as they focus on profitability, and it's important. But anyone who's coming into this market looking to raise money, you have to really focus very much on your unit economics, knowing how to, stay or remain lean as possible. At the same time, make sure your product market fit is absolutely right for the market.
Okay, thanks very much. And then, so we've got some context now about the macroeconomic climate. Let's go back to the question then, the front line, insights from the front line. Uzoma, what is the front line for you at the moment? What are you kind of battling, or what are you growing? How, who are you doing battle with day to day?
Everybody.
Everyone.
All my stakeholders. 360, so I'm starting, and the battle is I get the battle. I'll call it battle is the challenges. The battle one is of course, my primary stakeholder is my customers, and that education, right? Why am I different from this other person, right? What is the value add to me? So you must remember I have limited capital, and resources. So I'm trying to manage those resources across my stakeholder group. So that's those are my customers, but that is a battle that is going to continue growing. But I think it gets easier as they get older, because I'm hoping that Gen Z and millennials in the next 5 years, right, will be the bigger part of the economic generation. So that way it will be an easier sell. And right now I'm dealing with Gen X's like myself, and then you have the regulator. Now, I think the regulator from two sides is a real battle, because you do have to, as a business that is new and that is not your mainstay, you have to engage. You have to find a way to engage the regulator, because your traditional competition is in their face every single time, right? And then you have to educate them from the perspective of, the only risk profile that you're seeing here is the technology risk. Everything else you're doing core banking. And the second bit too is actually the regulator, and I think it's transparency as well, because I don't think the regulators in Nigeria are transparent enough in terms of saying, all right, these are the bad guys in fintech, and these are the good bad guys in banking, and these are the good guys. So what they do is just blanket, fintech can be dangerous. That already just sends the wrong signal, and suddenly, I've written quite a few blogs saying, I'm not a fintech, because I have to tell people that, I'm a bank, I have a banking license, and, I have fiduciary responsibility. And then, of course, there's also my competition as well, especially traditional banks who are also part of the problem as well. But I think the biggest challenge, too, is because to provide the services, you need people. I think people, especially in Nigeria, are the biggest challenge. From a skill perspective, and also from, it's just, I'm dealing, when I was in Diamond Bank, I think I was lower than the average age of people there. Now, I'm 55 years old, and I think the average age is about 26 and 25, and a different breed of people. I mean, they are a different breed of people, right? I mean, the HR policy is completely different there, and so you have to. I'm so happy I have 21 and 22-year-olds, because I actually understand and I get them. Like they do something wrong, and you have to even find a way to reprimand them in such a way that you do not actually affect mental health. And this is a new experience, a new life for me. So those are the challenges, and they're quite real, and I face them every single day.
Every day's a school day in terms of learning to deal with people. But you mentioned talent there, so obviously, Chika, this is something that you know a lot about as well. Having not just hired, I'm sure, hundreds of people over the years, but also now developing, building and scaling a talent platform as well. What's your front line?
Yeah, we're dealing with, as a business, like making sure that the fundamentals are good enough for us to survive. And by that I mean, cash is coming in, and we're able to bring down the expenses sufficiently. On the talent side, we've had to see a lot of people who we recruited in, and for many people were their first job, and for all my career, I've been like somebody who is very big on building talent and developing people, so having to let a lot of people go over the last couple of years, has been challenging. But we, get a lot of joy out of seeing them go on to do really well in other industries, and really, in a way, we have trained people both as a business and both as a service and for our business ourselves, train people for the ecosystem. I think the big challenge now for me is patience. So really managing myself around, because there's a reason why I hadn't run a business for 10 years and I came and started this business. So there's certain things I wanted to see happen. I wanted to see, thousands of, hundreds of thousands of young Nigerians being able to participate in the global tech opportunity, and to play like a very hands-on role in catalyzing that. And we've done that to some extent, but we're so far behind. And Gen AI is throwing a lot of uncertainty into what role is there for lower, the Africa sort of value proposition is high quality, low cost talent, right? But to what degree is that value proposition going to remain valid to European and US businesses? So trying to figure that out and be patient, because I want stuff to happen now, right? And there's a limit to being able to do that. I think also, therefore, trying to really get really good at returning to the fundamentals, like understanding the fundamentals of what does it mean for me to be a good CEO, so to manage my leadership team, like fundamentally, like what does that mean to be really good at building and managing an executive leadership team? And what does it mean to be really good at growth marketing, like help the growth marketing to be good at that? What does it mean to all the real pure fundamentals? You kind of, it's something that you think that maybe you should have outgrown, but you can't outgrow it. If you're in the job as a CEO and a founder of a company, I have to help my company focus on fundamentals of building a good business. So I think that's the most important challenge for me.
And wanting things to be done now is symptomatic of every founder, CEO. Mike, I'm guessing you're the same. Yes?
Yeah.
Yeah. How do you cope with that? How do you deal with it in terms of, managing the front line, trying to build a business, but also kind of injecting this sense of urgency into your customers, your clients, your stakeholders, your team, everyone?
Yeah. Great question, but let me zoom out for a second, and I also think in a negative cycle like we're in now, there's almost like a rebound to go back to, yes, like the fundamentals, the unit economics, the slow growth, get it right in one place before you expand. If you kind of zoom out, like here's the reality in Africa. There's now 1.5 billion people. This is a space we operate in supply chain. So there's over 100 million micro and small businesses that go from a trader, tabletop seller, to corner stores, to small pharmacies that are supplying goods and services. They're getting their stock from tens to maybe hundreds of thousands of family-run wholesale businesses and distributors who are then connecting to networks of both global manufacturers and local manufacturers and regional businesses. There's technology, you've got internet connectivity, so big technological shifts, right? So internet connectivity, smartphone penetration are becoming ubiquitous, still some gaps in the market. And most of that still happens completely offline, and it's mostly still in cash, right? So this is a little bit of the hidden secret of fintech and the startup world. Anybody who even says we've got a big number, they're talking about hundreds of thousands of customers. When I'm saying there's hundreds of millions, hundreds of millions out there. And the population's average age of 19, and it's growing super quick. Birth rates are still high. So this is a big opportunity, but in some ways also a big challenge. And so when we started with Boost, we had that macro condition, or the macro vision to start and say we want to build a global business across emerging markets, but we need to solve this first in Africa. And we launched in Nigeria, Ghana, and South Africa during COVID remotely from day one to try to figure out, can we build DNA in our business that we actually build a competency on how to go to market and make that our competency. And now we're in 6 markets, and we have a total headcount of 20 people. Because we figured out some of the principles around this, if you hire too quickly and your headcount's too high, not only do you run out of cash faster, you need to raise more cash, but you can't manage all those people. If you get into logistics and your asset business, you get stuck, right? So figuring out how do we be the role of an enabler, focus on really good technology, have the people we hire, everybody needs to be the best possible person. We've got to work as the best possible team. And you can then figure it out. The scale really, really happens. And so that's really my front line. And we've got now the team that's motivated, and I don't have to inject any urgency in anybody because everybody's fully driving because they see the opportunity is huge. And then you have as we've talked about, all the day-to-day constraints of hey, the currency just halved, and things are slowing down, and the contracting took too long, and we don't have enough runway, and we have to go without salaries for the next 3 months because cash is tight. You operate in these environments, but that's also what founders do. That's why we need entrepreneurs in the world, because they solve problems and figure this out. And maybe I'll close and say what I find as a challenge personally is there's also a big disconnect. When I'm pitching or having conversations with investors, a big disconnect of what even the questions are that are being asked, and due diligence, and nobody, as a technology company, nobody's ever asked to meet my co-founder CTO or to actually look at the technology or try the product. There's a lot of tech investors in Africa. Nobody's looking at the tech to see if it's scalable. Elizabeth Rossiello mentioned earlier about culture. Nobody's looking at what is your culture, your broader team. As an operator, these are the things that actually matter, right, in your business. Everybody wants to know what's your go-to-market and what's your unit economics, and like all that stuff's really important. But I just think you've got to balance that big picture vision and like the scale, because that's why we're doing this. It's like to really make an impact at scale. But then the flip side, break it down into like what is happening today and this week, and to actionable steps, and like get really, really good at execution and have a good design that can kind of get you from path A to B.
That's helpful. Thank you very much, Mike. And then, so you mentioned there about some of the challenges and some of the questions that should be being asked. So, there's a lot of chat about, VCs and due diligence and life cycle of deals, etc. But what are VCs asking? Question number one. And what should they be asking? I'm going to start with Uzoma actually on that one.
So, I mean, like for my type of business, I think it's first of all understanding what I'm trying to do, and to like understanding what are you doing, what problem are you trying to solve, and what is the industry metrics there, right? And so the industry metrics when I look at, private equity. So when you look at banks, you look at what's your cost to income ratio. Actually, that's actually one of the biggest ratios that you want. And because what is it now, and where do you want it to get to? Because that is what drives your sustainability. Or what's your return on equity? And that return on equity is what your profit is going to be. What is it now, which is zero, which is minus something. But where do you see it, and how do you see it, and what's your strategy to grow it? And the biggest one too is like, okay, so what's your risk strategy? Because you are a bank, you are in financial services, and so how are you going to deal with all those risks that are going to be done with? So because when you start looking at if you say okay. So if you're going to use transaction metrics, right? So tell me what your customer strategy is going to be like, because I think one of the biggest, what technology has done is, and what technology does in any industry, it facilitates, it scales things, and in some cases it weaponizes things. So like fraud, right? So like the barrier to fraud has actually lowered. So everybody's in there. Now, if you're in a country like Nigeria where there are no jobs, there are no meaningful jobs, and it's easy for you to get a smartphone, and it's easy for you to get internet access, and it's easy for you to like go into like trying to see how you can do some code and go into bank. That's the easiest thing to do. It's easier than farming, and so you find that most organizations, most new businesses are focusing on, like, for example, fintech payment side, right? But no one's looking at how much have you invested in cybersecurity, how much have you invested in risk management. Those are the kind of questions that you want to ask people, because it means that if you've thought about that, your country, your business is going to be, how much capital have you invested in the right places? How are you going to allocate the capital? It means that you're thinking about the business in 5 or 6 years' time, and you're thinking about those questions. The business is going to be here, the business is going to be profitable, and the business is going to be adding value to the community. Those are the fundamental things. Transaction volumes can go down in an economic cycle. How are you going to deal with it? If you don't have those answers to those questions, you have to be very worried about that business.
Okay, interesting. And Jermaine, what are the questions that VCs are asking you, and what should they be asking going forward?
So a lot of the questions they're asking is around, one is the unit economics. I think they're very, as a startup, when you put a plan together, and I've realized this over time, is you have so many different drivers leading towards that path to profitability. It makes it more difficult for VCs to understand and believe your case. So I think what's important that they're asking us is try and justify all of those different situations. I think what's important is, as you put together plans as founders, is focusing and narrowing it down to certain KPIs, which you are very comfortable growing, and leaving all the other KPIs more or less, flat, that you've proven out. So then at least it makes it easier to sell your case as you're driving the business forward. Many, I would say, startups today are sort of putting in so many different KPIs which are driving growth and leading towards that path to profitability, and is making VCs very skeptical of their business models. So I think a lot of the questions they're asking is drilling into those details and trying to get very comfortable that they themselves believe what you're trying to do, because they're no experts in your industry. So the less where you could, where you have, or the more things you can prove that are proven, makes it easier for them to be able to then justify. What they're not asking is, a lot of them are very much focused on burn. And I don't think they sort of understand the fundamentals of what make up that burn. So I think, as VCs go forward, the questions that I think they should be reflecting on more is trying to get a better sense of your unit economics and how that translates into your burn, rather than just, not asking the right questions around it. They also don't have a good grasp in terms of industry knowledge, and I think it's important that now, obviously there's many VCs that are sector agnostic, so it's important for them to go out into the market, speak to many industry experts, and I think they need to bring those industry experts into their discussions to help them frame that logic, because, like you said, they're not. When VCs meet with the CEOs, they're not asking to meet with the CTOs. They're not trying to understand the culture. They're not trying to understand all these things which make up an organization and help drive the right leadership or the right talent in order to get the results you want. So I think it's important that they need to start looking holistically at your business rather than just looking at a few financial KPIs that get you there.
And Chika, from your perspective, when you are at the front line, your business building and your operations and everything else, what's the most irritating question VCs? It's the end of the day. What irritates you the most? And it might be more than one thing. You might have a list.
Now it's very different from earlier on. Earlier on in my journey, when I started interacting with VCs, I had tremendous respect for VCs, because when somebody has money and you want the money, so you just think that money and wisdom are together.
Yeah.
So I've suffered a lot from that. But now I know that they are not, partly because me too have been trying to invest or being responsible for companies I don't, they just don't know enough about the business. Mm-hmm. And so now I just, I'm very patient, because I know that day to day, they don't know what they are. I mean, generally speaking, right, they're also trying to figure it out. But I think, and I find it irritating when I get advice now, like advice around pay attention to your unit economics. Or now there's a lot of VCs telling you that unit economics matters and that profit matters.
Oh wow, thanks for that. Okay, you're being diplomatic. But actually that's interesting, because you're saying that, it's obvious to you that unit economic matters, but do you think that VCs are saying that because there is a crop of younger entrepreneurs, not being ageist, but there is a crop of entrepreneurs that maybe don't understand the importance of unit economics?
But I'm telling you that by the first companies that I received capital in, some of the investors, when they come for a meeting, they say, how fast can you spend this money?
Yeah, totally.
So we would have been thinking, okay, it's like how fast you spend money, is that like a KPI? Yeah. Or when you talk about profit, it's as if you're not ambitious. Like profit and ambition, and I can understand why, or I understand where they're coming from, but there needed to be a lot more nuance around that, and a lot more thinking about I think there needed to have been some kind of frameworks for thinking about, how mature businesses have balanced scorecard, because eventually they figured out that only looking at profit is not good, so they brought out, right? So I think that for early stage companies, there has to be some kind of composition of those type of things, where when you're having a conversation, if the meeting is going to be about growth, let it be that there's a framework in which we're talking about growth, but it's not as if it's only growth that matters. So what I'm trying to say is that there are a lot of founders now. Majority of the founders now came into the industry where they were indoctrinated the wrong things. And people sometimes are frustrated with the founders, but that's the music that was playing when they entered the party. And so, I think fundamentally, if you look long term, that's why I said this is a very good time, a very important time, because because that was always bad. It was always going to be bad, and we were never going to be able to build big, strong, sustainable companies. So this gives the opportunity for us to learn, for people to learn how to build companies properly.
And Mike, have you developed a KPI for how quickly you can spend money?
No, but I totally get that. So my KPI is how capital efficient we can be. Because I learned this my first time around. I had those KPIs from investors of like, grow, hire ahead of the curve, expand. And I promise you, if you're pitching to an investor and you're talking about, they all want unit economics, they say that, but if you're talking about that in your pitch, they will not fund you, right? They want like the hockey stick graph to go big and how you're gonna go Pan-African, right? And until you get mature, once you're like really mature, like as a business, then like things might shift and you get into the private equity world. But in the venture world, like good luck, you just won't get the money. So as I personally have learned through many years of experience in failure and false starts to separate the fundraising process from the running the business process, right? Because it's a different, there's an overlap. So you have to be very careful and make sure the narrative is true and authentic and comes with a lot of integrity. And you never lie and make up numbers and all that stuff that some people still do. But then when the money is in the bank, you need to then say and get the founding team together to be like, okay, let's not assume that this money is going to last as long, or the plan that we pitched on our deck is going to happen, and the next round is going to be there at a higher valuation from bigger and better investors. Because that's like a very dangerous time in a company's life cycle, because you have all this money, and you have all this pressure from the people who've now invested in you saying, okay, you've sold me this vision, like let's go. And I want to see this, like the numbers immediately jump from like where they are now to something bigger. So then what you do as a founder, you have this incentive to like spend the money on taking on the people and the costs and going into the new markets and launching the new products. But then your costs ramp and then your revenue doesn't. And if you're lucky, your revenue will catch up. But that's like the time where you need to step back and be like, okay, how do we, we're stable now. How do we do some experiments? Make sure anything new we do, we get like the product market fit in the new market. Any hire we do, we have like a higher bar of who we hire because the stakes have risen, and using patience, I think, is a really good term for that. So
interesting. And so we're almost out of time, so we'll just kind of, I guess, final question, quite short if possible. What's harder, actually the front line, as in doing business, or dealing with VCs? We'll start with you, Mike, and then we'll go down the line.
Dealing with VCs.
Okay.
Because that's mostly my job.
Okay. Chika?
Yeah, I would say raising money, dealing with VCs. Right? But I think that's because there are some people that they find that easier and don't want to operate. But people like us that like punishment, like operating. So yeah,
I agree.
Okay. Uzoma, frontline or dealing with investors?
Well, definitely investors.
Okay. Jermaine?
I'll say frontline.
Okay.
Because you want your business plan to always go in the path that you want it to be. But if you can't achieve that business plan you sold to investors, you can't raise money from them. So if you can deal with the frontline challenges and get over that, you'll be in a good place to actually raise money.
Very good. Okay, thank you very much. Does anyone have any questions at all for this mega panel? Yes, sir.
Thank you very much. What about investors who actually bring this frontline experience, like former operators who then turn VCs, because we don't see that many of those. And from the experiences that you share, it seems like most of the VCs you've interacted with come from a financial perspective, right? They're focused on unit economics, profitability, those kind of things. And you also mentioned earlier that you also mentioned earlier that it was mentioned that some of the investors lack industry knowledge. So, what about, founders or operators turn investors, within the continent? Do you see them? Do you like them?
Great question. Mike is itching to answer.
Yeah, those are my favorite investors. And we found even with small tickets, because not only can they understand, they're helpful, they get the context, awesome. And I found like with building Boost is like good quality former operators, angel investors is great. And sometimes it's amazing how you can get very contradictory advice. So you can talk to an associate or like at a fund, and they'll be like, come back to us when you like do these things. And then you talk to somebody who knows the sector, your industry, and they get the real business. much quicker. And if you get money from them, then they're champions and they can really unlock doors. So it's a great point.
Thank you very much, Mike. Any other questions, anyone?
Yeah, I want to say something about that. Just that, like, if you look at in Silicon Valley, the investing landscape changed as operators started getting into investing.
Yeah.
And I think that we sort of have that in Africa. That's
We're seeing it already in terms of, Andela Mafia, Flood Wave and Paystack founders are investing into the market.
And I think, again, I keep saying now is a good time, but so I was early in that, right? Because I was operating in 2012, I started in 11, so I started investing. And what the problem then was that I was the guy who, after the investors come and they leave, because I was an early investor, I will say to the founder, don't mind them, this is what we're going to do. But over time, the founders started liking what the investors were saying more. Yeah. When I say don't mind them, they'll say it's you that we're not going to mind.
Oh, wow.
But now, I think, the investors and that's the financial investors and the operator investors are now saying more and more of the same thing.
Got it.
So I think there will be less dissonance and confusion for founders.
I think we're almost up. I actually have a kind of follow-on question here for Uzoma. So Uzoma, your first round was kind of a friends and family round from people that you've worked with and a lot of operators as well. Like, how was that process for you in terms of having your first wave of investors who I guess knew the business, but knew how you operated as well?
And I think because most of them were operators, run their own business, and knew exactly what we were doing, and it was easy for them to understand that this is patient capital, and this is just something different that you're doing. With everybody else, it was like, do what I want you to do what the other guys are doing. I want you to go into Africa. I want your African strategy, and so no, thank you.
Yeah. Okay. Any other questions at all, anyone? No? Okay, well, thank you so much, my brilliant panel. Thank you very much for your questions, sir. Thank you.